form of controls creates a rationing mechanism, be it food prices, or be it anything that you impose control creates a rationing device. So essentially, because the market must clear, then it creates a parallel market to clear it. Now, maybe that's too technical, but the most important thing is to say that if you are an exporter and you are exporting coffee, then you export to Europe and you get euros, do you have an incentive to bring those euros to Kenya when you know that you'll have different difficulties trying to get it out? So that incentive, that allows you to have an incentive not to declare. So essentially, the country start getting less and less of foreign exchange reserves. Similarly, are you going to produce maize if you know that you are going to produce it at a price that is determined by the government, and sometimes your cost of production will be higher? So then you have an incentive to produce and hold. But because sometimes it can be criminal, then sometimes you refuse to produce. So in a sense, it creates a disincentive to produce. It creates a disincentive to trade in the market because the prices are controlled. I cannot export because those proceeds, I will not get them. So I will not be flexible. It allows transfer pricing because then I would rather keep my money out there because I'm flexible with it. So essentially, it means that because of the distortion it creates in the market, we will never come back to it. I can say the formative stages of the central bank from 1966 was very, very important. Those formative stages were because they laid down what should be done. Those formative years are very, very important, and you can imagine those are the times when we had a Polish from IMF seconded here as the governor, and then we had Governor Duncan Dewa, and then after that Governor Philip Dewa. You can see the formative years, but then there came the troubled periods because of various problems, both socio-political problems, and then there were quite a turmoil until then Governor Chisaram came to put some order.
I took over the central bank, as you are aware, in July 1993. And in the previous year, in 1992, prior to the elections, up to the elections, it appears the government released a lot of money into the economy. So there was too much money in circulation. And when I was appointed in July, inflation was running at 80%. The value of the currency was falling very rapidly. And there was no foreign exchange. So when I arrived, challenge number one was the staff. There was a lot of indiscipline in the staff. Morale was very low. And obviously, because of those exchange control days and golden bag, there has been a lot of rent-seeking, dishonest behavior. So I had to deal with that. Secondly, at the bank itself, as I told you, there was already a lot of money in the economy. So we had to mop it up. We have to bring the money back, raise interest rates to bring the money back. Then we had to really remove remaining exchange controls because that was the big problem. And the other problem, up until my arrival, the central bank would not bounce a government check. The government could draw as much money as they wanted from central bank, even if they had no money. That really compromised everything. So we had to bring in a law to say there has to be a limit. And that has helped a lot. That limiting that the government cannot draw any money. So as soon as we arrived, it was agreed that all the government can draw money if they have credit on their account. And what they have to do is go to the treasury, check that there is money in the account. All their checks didn't come to central bank direct. They had to go through treasury. And that has helped the nation.
Even as the central bank tried to stabilize the foreign exchange situation, banks continued to face rising incidents of fraud. In August 1980, alarm was raised over the loss of millions of shillings from commercial banks through cash theft and forgery of client signatures. In August 2012, Kenyan banks had reportedly lost over 4 billion Kenya shillings in the previous 18 months to fraudsters operating in collaboration with bank employees. This was despite Parliament having raised the minimum fine for crimes in the banking industry from 1 to 20 million Kenya shillings. Besides the deterrent of heavy fines, banks would use advanced technology to thwart robbers and fraudsters. The use of technology in banking in Kenya, in fact, dates back to the days of the National Bank of India. The technology in use at the time, manual weighing scales, was fairly crude and mechanical. The weighing scales were manufactured in London and shipped in, already calibrated and ready for use. They came in varying sizes and used different weighing stones whose fixed weight was the equivalent of a certain amount of rupees.
We started with adding machine. Then we came to posting machine, that means doing the ledgers and what we call the waste, where you write hand the records, which used to be hand, we advanced to the machines. From machines now we graduated to more than that. That means, yes, technology had quite a big impact on us.
Huge volumes of books were used for purposes of keeping accounts, as well as documents that constituted powers of attorney and wills. Customers were issued with passbooks in which all their transactions with the bank were entered by clerks. Checks were mostly the preserve of companies and individual clients who were very wealthy. And in the 1950s, it took longer than a month for a check to clear. This improved to 21 days in the 1980s compared to 2 days at present. Beginning in the late 1960s, the main banks started investing in computerizing their operations. Barclays Bank of Kenya was the first bank to fully computerize its operations in the country. Its Barclays International Accounting System computer program was rolled out in November 1982, with its Enterprise Road Nairobi branch being the first beneficiary. Other banks would eventually follow suit and computerize operations in their branches. In 1989, Stanchart pioneered the use of debit cards and automated telemachines, or ATMs. Barclays, KCB and Co-op Bank followed not long thereafter. By early 2000, bank customers were able to access services from any branch of their bank, unlike before when one had to go to their branch. ATMs were enhanced to offer a variety of services besides cash withdrawal. These included cash and check deposit, issuance of mini-statements, and transfer of money directly to another account within the bank. Banks also interconnected their ATM networks, thereby allowing customers to access the services on ATMs beyond those of their banks. A case in point is the PesaPoint network of ATMs, to which the majority of banks subscribe. An even more innovative system of banking would come with the launch of the M-Pesa mobile money transfer system by Safaricom in 2007. M-Pesa has drastically transformed the way the majority of Kenyans send and receive money. Currently, most banks have adopted and integrated the M-Pesa concept in their everyday services.
We are seeing the tip of the iceberg. M-Pesa may eventually revolutionize, and it will. Banking will not be what we know. All these banking halls, you should not be thinking what to do with them. Because you may eventually find you can take your loan through mobile money. That is the new development.
I think mobile money is a major breakthrough, but I think we need to remember mobile money is just a product. So it complements the huge range of banking services by easing the issue of money transfer. I would see that as the greatest threat, maybe to money transfer systems that existed previously, but complements the banks and at the same time gives the bank an opportunity to add money transfer as an additional product. I would say the biggest contribution of money transfer, as it has been done in Kenya, was to really legitimize the use of technology. The phobia of trusting a phone Again, that has been dissipated by the money transfer. And the future of banking, using the mobile phone as a delivery, has been given a huge boost.
Most banks are also offering internet banking, where customers can transact their business on personal computers or smartphones in the comfort of their homes or offices.
I can tell you that in 2002, we had only 1.9 million deposit accounts. Today, we have 17.6 million deposit accounts. Because you are able to save your money through M-Shwari. So let's say, assume you are somewhere you cannot even have a bank account because there is no bank near you, but you can use the mobile phone.
Technology is important in banking, but it is beneficial only when it is used by employees who understand not just the technology, but the intricacies of the banking industry. In the pre-independence days, most banking staff were European and Asian. Africans entered the industry in low and junior positions. There was little facility for training local staff. Barclays DCO was the first bank to set up a local training school in Nairobi sometime in the early 1950s. The training school, which was to serve the entire East Africa region, was necessitated by a pressing need to train competent local staff to cope with a rapidly expanding branch network. It was on the back of this training school that Barclays rapidly expanded operations in Kenya, culminating in the opening of its 100th branch in Kenya at Mandera in 1968. The Barclays Bank Training School would be followed by others. Standard Bank of South Africa opened a training college in Nairobi in 1958. Bank of India and Bank of Baroda opened a joint school in October 1969. Co-op Bank would later start its cooperative training college at Karen in Nairobi, where also KCB's sprawling training and development center was opened in 1991. Subsequently, most banks set up their own colleges. In 1994, the central bank and commercial banks joined in the setting up of the Kenya School of Monetary Studies, which became registered with the Ministry of Education as a tertiary institution offering diploma and certificate courses. The central bank is the principal shareholder with 99% share and the remaining 1% held by the Treasury. Training enough Africans to take over the banking industry took time. What took even longer was to get enough women to play a leading role in banking. It was not until after independence that African women began to feature on the staff of many banks. Even then, they were mostly employed in junior positions as cashiers, secretaries, and receptionists. Mary Okello entered the annals of Kenyan banking history when in 1977 she became the first African woman to rise to the post of a bank branch manager. Her promotion at Barclays Bank opened the door for more women to rise to management positions in Kenyan banks.
Yeah, when I joined banking, the conditions there were not very accommodating to women and they were not very supportive, both as employees and as customers. Being the first, I had to prove that women can make it. Because if I failed, I would have failed the other women also. And they would have been saying, oh, we gave her a chance, she didn't make it. So it would have closed doors to many women. So I really had to prove that women can make it. Yeah. I'll give you an example. In 77, I was promoted and sent to Westlands branch. It was a rundown branch. The morale was low. It was not making a profit. So when I went in there, I knew if I didn't turn it round, they would say, look at these women. You give them an opportunity. But by the grace of God, I turned it down. We started making profit. The morale went up. Because there are more women now, and if you look around, there are many women CEOs, there are more women in managerial positions in the bank. We have had women directors, We have women chairing banks, so I think things have changed.